This podcast is brought to you by TaxCalc. Tax, accounts and practice management software loved by accountants in firms of all sizes.
Welcome to the TaxCalc podcast of the TaxCalc webinar, Autumn Budget 2024, Expert Analysis with Sharon Cooke, presented by Andy North, Dean Shepherd and special guest Sharon Cooke. The original webinar was broadcast on the 6th of November 2024 and can be viewed at www.taxcalc.com/events. Please be aware that deadlines, rates and other technical details referenced may have changed since this date.
Good afternoon and welcome once again to TaxCalc TV. This is the 2024 Budget Analysis Special, in which we will be getting behind the headlines and into the weeds of the announcements made last week by the Chancellor. I am Andy North, the CMO here at TaxCalc, and I'm joined, as always, by Dean Shepherd, our Resident Director of Product Compliance, and also the wonderfully insightful Sharon Cooke, Head of Tax at 2020 Innovation, who will both be sharing their unique insights into what the budget means for you and for your clients. In the next hour, we will be meeting no fewer than 5 completely fictional characters, each in a unique position to illustrate the impact of the budgetary changes. But before we meet them, Sharon, would you mind introducing 2020 to any of our viewers who've not had the pleasure of meeting you before?
I would be delighted to do so. So hi everyone, I'm Sharon Cooke, Technical Director at 2020 Innovation. We're a company that works with accountants predominantly in the UK, but also across the world on training and compliance. So really pleased to be here today. We've got a bit of 2020 news, if I may.
Please share.
Yes, so our family has expanded. So we've gone from a team of 32 to a team of 40 this week, and we have incorporated the Ross Martin businesses into 2020, which means even more tax resource and even more reason for 2020 and TaxCalc to work together.
Congratulations on that. Well done to you both. And I think it's going to be busy at Christmas, isn't it?
Well,
at the 2020 household.
We'll have to get some more chairs.
Yeah, it's going to be, I'm not sure who's cooking this year.
I hope it's not me.
Oh no, well, you never know. I wouldn't trust Gordon. So let's get started. But before we meet our fictional friends, a little bit of housekeeping. First of all, yes, a recording of this will be made available. And also, I would once again plug our podcast series, which is available from anywhere you get your podcasts. Just search for TaxCalc, and you'll be able to listen to this session as well as all of our other ones, wherever you are and whatever you are doing. Secondly, we know that you, our TaxCalc audience, is never shy, but this, in the case of this is your first time of watching, we love your questions and we love to hear your comments. Please use the chat function, bottom right of the screen, to share whatever is on your mind, but be aware that whatever you say will be seen by everyone, and also it will get very busy too, so we may miss it. Your alternative, if you really want something to be seen by us, is to use the Q&A function or the questions function, but only we will see those questions. So, without further ado, we'll get started. Dean, I think we've got a poll to kick off with, right?
Yes, we do. Right, let me just make that live in our system. Okay, so I'm really interested to find out what communications activities you do with your clients every time there's a budget. So I've got a number of different options for you here on the screen. You can tick all of the ones that apply to you. So which of these budget communications activities do you organise for your clients? So we've got live updates on social channels where you, like myself and Sharon, dialed in live, pens at the ready, firing out all the information as it comes in. Do you organise any in-person events for your clients to get everybody around perhaps for a budget breakfast and dissect what's been announced? Or do you run a similar event but you only run it remotely, a webinar like we're doing today covering all aspects of the budget? Do you send a general budget newsletter to your clients? We've got one option there, email newsletter for your clients, and one option of a printed newsletter. I'd be interested to see which practices still print off and send out a physical newsletter to your clients. And the final option there is a targeted budget content for different client segments. So rather than sending a whole budget newsletter covering everything and sending it to all your clients, do you pick and choose what elements of the budget were of most important to different segments of your client base and only send it to those. And of course, if you don't do anything, none of your clients are interested in the budget and neither are you particularly, then please do the none of the above option.
So, yes. Okay, well, let's get started while we wait for the results to come in. Who are we going to meet first, Sharon?
Shall we meet Matthew? So Matthew is what we're calling a working person. And of course, in the run-up to the budget, there was a lot of debate, was there not, about who is a working person. So we'll leave that a bit woolly around the edges. I don't know if we can... Yeah, we've got the slide
There's
on
Matthew.
screen now.
Here he is.
Here's Matthew. So he is a working person. And of course, the reason for the debate in the run-up to the budget was that in the Labour Party manifesto, they had promised that they were not going to increase income tax, national insurance or VAT on a working person. And certainly during the election, that was very much being positioned as that we're not going to increase income tax, national insurance or VAT, full stop. But as we got closer to the budget, I think the Labour Party were pretty clear to make the point, no, just for working persons. So indeed, if we take a look at Matthew, we can see the headlines, as the Chancellor promised, are that nothing is really changing. So technically, income tax rates remain unchanged. I would just put a little star at the end of that we haven't yet had the Welsh or the Scottish budgets, but based on the budget we've had so far for UK, the England and Northern Ireland components anyway, as we go into the 25-26 tax year, income tax rates for regular income, savings income and dividends income all remain at the same rates. And from the personal contribution point of view, whether a self-employed person or an employee, Matthew is paying the same rates of national insurance contributions. We were just going to mention, though, on the income tax point, that there is a little bit of a sneaky undercurrent behind that, isn't there, Andy?
What about that they're potentially not as untouched as we suspected?
It's this whole thing about fiscal drag and where the limits, so things like the personal allowance, the top of the basic rate band, the top of the higher rate income tax band, where they're not moving and yet earnings are increasing, what we're just seeing, and we have been seeing for a number of years, is that as earnings increase, more and more individuals are falling into the 40% bracket, for example. So that fiscal drag, as we call it, is still ongoing and is going to be ongoing until 2028. Although a little bit of good news for Matthew, if he can hold tight, the Chancellor has said she will stop the freeze from 2028. But we've got a while to go until he's going to see his income tax bands shifting up.
Well, I think Richard's been quite cruel about Matthew, saying that he was gormless, which I disagree. I think he's
I don't know what Matthew did to bring that on, but yeah, I'm sure it wasn't intentional. Also for Matthew, I mean, maybe he's just feeling a little bit despondent. But if Matthew is on the national minimum wage, what he is going to see is those national minimum wage rates increasing a little as we get to 25-26. So while we're thinking about Matthew, we could position this as good news. Of course, when we flip and have a look at employer in a moment,
it's a different picture.
A bit of a different picture. But we can see here that the national minimum wage rates are going up from 1st of April 2025. And in particular, for those on the national living wage, so for those aged 21 or above, the rate is going up from £11.44 an hour to £12.21 an hour. So if Matthew is on the national minimum wage or the national living wage, he has got a bit of an uplift coming his way as well. Now, I was just going to say there are also some other changes on the periphery that could affect our own personal definitions of a working person. So if Matthew holds assets, we're going to talk in a moment about CGT rates increasing, but we're just assuming for now Matthew isn't holding chargeable assets. And if Matthew is about to buy residential property, either an additional home or perhaps his first home, he will see SDLT rates increasing, some of them straight away, some of them from April next year. But again, for now, we'll assume that Matthew isn't buying residential property.
So in summary, the outlook for Matthew is pretty much same.
flat.
Flat.
I think it's very much what the Chancellor wants to put out there, that Matthew's pay slip, if he's an employee, his net pay is going to look the same as it did last month. And going forward, it should look the same. But of course, the biggie there, I think, is the assumption that has been taken that if Matthew is an employee, he isn't going to feel an impact of the changes we're going to come and talk about in relation to employers. And we will talk about that more when we meet Andy in a second. But of course, if employer costs are going up, someone is going to have to feel the brunt of that, whether that's employees, stakeholders, or consumers.
So there may be fewer of them. So we have, before we look at the poll there, so are the minimum and living wage different things, says Debbie. Question for you.
It's something our proofreaders on Budget Night often bring up as well. So the technical answer to that is the national living wage is the wage that applies to people aged 21 and over, but it works in exactly the same way as the national minimum wage. So if I pop that slide back on the screen for those of you that are looking as well as listening, we can see that the national living wage is the top row of the national minimum wage grid. So the apprentice rate, the 18 to 17 year rate and the 18 to 20 year old rate, they are national minimum wage figures. If we're age 21 plus, I think we're all in that group here today, aren't we?
Just had a recent birthday. So,
yeah, okay, yeah. So yeah, been there. We'd all be in the national living wage category. So I hope that helps answer that question. It is a weird one.
So it got another question. What if Matthew has BICs?
Benefits in kind. I had to think then.
Benefits in kind. BICs. Yes,
yeah.
depends.
I was like, I'm not.
Does he use biros, fountain pen kind of guy?
If Matthew has got benefits in kind, he is going to pay income tax on those benefits. So if he's got I was going to say company car. This is going to get more complicated. If he's got a company car benefit, the percentages that we use to work out the value of that benefit, they are increasing slightly at the moment, and the increase will get a bit higher after 2028. But the income tax rates that we apply to the value of the benefit, of course, stay static for Matthew. So the benefit calculations may change a little, but there's nothing too dramatic going on. So company car percentages upping a little. We're seeing things like the fuel benefit, the van benefit, upping a little by consumer price index. But yeah, nothing radical going on with benefit calculations. So other than perhaps a little bit of a price in uplift on the calc itself, it should feel pretty static for Matthew.
Fabulous. Okay. Well, how did the poll go? What was the outcome?
Yes, very interesting. It kept changing back and forth between whether people were doing an email newsletter for all their clients or whether they were doing nothing at all. Nothing at all was leading the way for quite a while, but it's just been overtaken by people that are still sending an email newsletter. And then I think I'm quite pleased to see this one next, and that's the targeted budget content for different client segments is the next one. So 22% of people are already doing targeted content, which I think is great.
It absolutely makes sense. I think with any message delivery, as a reader, when we feel like it's been written for us, it just feels more valuable, doesn't it?
Yeah.
It's something we've been doing a little bit of at 2020. So in fact, these personas are the front pages of our budget newsletters and our tax rate product. So that is still a single document at the moment for accountants to use to communicate, but we're hoping the personas really help the reader get straight to the point. So if our situations like Michael, Michael. Yeah, Matthew.
Gormless Matthew.
Gormless Matthew. He can get straight to the bits that affect him. And I think that's a really good way of doing it. And I'm sure as tech and systems develop, it'd be wonderful to be able to just get the bits that are relevant for Matthew out to him. Fascinating.
Question from Bobby: when calculating annual salary based on national minimum wage, how should this be calculated? E.g., 11.44 times 37.5 times 52. Would that be correct?
Yeah, it's an interesting question, and again, I'm pausing while I think about it, and we'll pop the rates back on. So it should reflect actual hours working. I guess, is that question referring into, say, director salaries, which might be why, because of course outside of directors, people have got employment contracts and it should say the number of hours that person's working, and we should then be multiplying that by the national minimum wage to make sure that we are compliant. For directors, there are special rules that it probably isn't sensible for us to get into now, but generally you're looking at the contract, looking at the contracted hours, and making sure that we are paying that as an absolute baseline, and being very, very careful with any deductions. So any treatment of benefits in kind, any treatment of loan deductions, there's all sorts of things that can land an employer in hot water with the national minimum wage. So we want to make sure that our clients are either meeting it dead on or ideally giving themselves a little bit of a buffer above it where possible.
Okay,
I think there was also something in the press about employers that were paying the appropriate amount for contracted hours, but actually a lot of the employees are working longer hours than that. So the actual hourly rate they were getting for the hours worked was dropping below that minimum.
And I must say, I'm not actually sure how that hits national minimum wage, because if the employee isn't legally required to do those hours, I'm not sure that would affect national minimum wage. But Dean is saying he has read something that suggests
I think it was a topic that was being debated.
Yeah, we've got to be careful. We've got to be careful with it. There's been some big businesses in the last 12 months that have been hit with fines as a result of national minimum wage. So we do need to be careful.
So Bobby said, just for standard employees, as some months where there is 23 days, the software will give a warning that this is below national minimum wage.
Yeah, it probably is a more detailed payroll point, and I think without me doing more research, it probably isn't something I should comment on now. But we can look at it.
There's plenty more to be looking at. Just do have a couple of questions that I think we're going to be picking up around pickups and double cab vehicles.
Yes.
Do you want to do that now, or do you want to wait until?
Let's do it under businesses.
Okay.
Yes, we could. Well, we can do it whenever. If you want to do it now, that's the question. We can.
I think we should wait until the businesses, because I know you've got some very nice slides on that.
Yeah.
So
Okay.
who are we going to meet next? Which of your family are you going to bring in for the next
Andy,
session?
What about if we meet Andy?
My best friend Andy.
Yeah.
Look at that. He's a business owner.
Andy and Andy. So Andy is a business owner. I don't know why my slide then says if Nancy has employees. I think it's fair to say that at 2020 Towers, we had quite a full-on week with Budget Week last week, and we've obviously all lost our minds. So Andy, and Nancy are all the same people. So apology to that typo. So this budget that we've seen in the last week did two main things, really. So we have seen the Chancellor revise the debt rules so that she can borrow more to enable her to spend more. So we've got total government borrowing going up to 127 billion off the back of the budget. And we've also got 40 billion of tax rises. Now, we've seen through meeting Matthew, the Chancellor's been very keen to make the point this is not on working people. But that 40 billion has got to come from somewhere. And in the main, the brunt of these tax rises are affecting business owners, so people like Andy and indeed Nancy, and those that perhaps we classify as more of a wealthy individual, though the whole thing with these personas is everybody is different, and an asset owner doesn't necessarily make somebody a wealthy individual. But asset owners and business owners are those that are taking the hit, really. So in terms of Andy, our business owner, he has got a few things on the horizon that he will need to factor into his business plans and forecasts for the year and years ahead. And I'm sure these are things that he will be keen to be talking with his agent, you guys, about. So if this business owner has employees, of course, a big chunk of that 40 billion is coming from employer NIC increases. So if we just jump into my employer's NIC area, let's have a look at this. We can see there's a few things that are impacting. The headline is absolutely, if we have a look, again, for those of you with the screen in front of you, third row down, the main rate of employers' NIC is from April next year, so not immediate, from April 25, increasing from 13.8 to 15%, not just on wages, but also on benefits in kind, on PAYE settlement agreements. So the employers Class 1, Class 1A and 1B are all going up to 15%. And to drive that in a little bit harder, at the top line, we can see that the secondary threshold, the amount of salary after which an employer must start paying employers' NIC, in most cases, there are some exceptions, but in most cases, is going to drop from 9,100 to 5,000. So before I get on to the third component, that means more of an employee's wage is giving rise to employers' NIC, and at a higher percentage. Now, to soften that blow a little, and even to leave some business owners in a better position, what we're also seeing is the Chancellor increasing the employment allowance from April 2025. So this is the amount that can be offset against an employer's total employer's NIC liability if they are eligible to claim it. And the eligibility criteria is softened a little bit at the same time. So previously, if an employer had spent more than £100,000 on employer's NIC in the previous tax year, they wouldn't have been eligible for what's previously been a £5,000 giveaway. Now that 100,000 limit has been removed, meaning more employers will be able to get the now £10,500 employment allowance. So that will help. It will offset the additional cost partially for some. Now, I'm sure some of you have already got calculators at the go. It does depend on salary levels, but if we were, for example, looking at an employer employing people on an average salary, which these days is around £36,000, generally, if they've got 6 or fewer employees, they're going to be better off as a result of this measure. The employment allowance is going to cover the increased employer's NIC and more. But once they're looking at 7+ employees, then that cost does go up. And of course, that 6-7 divide only works if we've got people all being paid this average £36,000-esque salary. Accountants tend to love a graph.
Oh, go on. If you've got a graph.
Let's put a graph on the... So this just shows what I was just talking about. So this is how many employees on an average salary, not the national minimum wage, and the impact on costs. As we can see, when you're looking here, that isn't actually a radical difference, but employers will start to feel it depending on salary levels and how many team players they've got. But the orange line is the new total cost of employing 1, 2, 3 to 10 employees on an average salary of £36,000. And we can see the orange bar starts to trump the blue bar after we get past 6 employees.
It's a hair's breadth though, isn't it?
It is. It's the way the it's because, of course, employing people, it costs a lot of money, doesn't it? So the difference between a 13.8 and a 15% add-on, when you look at stats, it doesn't really pop. But the extra cost for employers, that, let's face it, a lot of them have already done their budgets and forecasts, even if informally, for the next year. This is money that does still need to be found.
And what was the figure again? The expected income?
Well, yeah, so over the course of the next Parliament, so starting in 25-26, when this measure will come in, the government are forecasting that this move, I'll just put the stats back on the screen for anyone who wants to look at it. The forecasted tax revenues from these changes to employers' NIC are expected to bring in initially £23 billion a year, and by the end of the Parliament up to £25 billion. Now, the government have acknowledged that the public sector are the biggest employer, so they do net £4 to £5 billion off that. So roughly, we're looking at a £20 billion per year tax take. So the graph doesn't really show the
impact of that,
the severity of that. There's a lot of tax revenue being collected, especially initially, and the government are looking at employers to fund that. Now, one of the questions I think to raise around the forecasts for economic growth for the period of the Parliament is those numbers are assuming that salary levels and salary projections remain as now. But as we started talking about earlier, most employers are not sitting there with a pot of money for future tax rises. So that difference between the 13.8 and the 15%, it's got to be paid for by someone. So either the stakeholders, the owners of that business, accept, hey, we're just going to take lower profits, or they're going to pass the extra costs on to consumers. It will come through pricing, or it's going to come out of the employee cost pot through reduced pay rises, reduced bonuses, reduced recruitment, and in some cases, particularly those that have got, we've actually got a triple whammy for employers, and we've talked about two elements already, but where we've got the national minimum wage uplift and we've got employers' NIC uplift, I mean, this could be a job loss situation in some businesses, without doubt. And of course, then if remuneration costs come down, well, so will that 23 to 25 billion. So it's an ambitious move from the government, and we'll have to see how that
pans out. And this may affect the Gormless Matthew as well, because obviously
absolutely
we thought he was okay.
We're saying we're not touching working people, but if that working person's employer is getting 50% of the tax burden put on them, it does seem a little unlikely that every Matthew out there is going to be protected from it.
So I have a whole bunch of questions to throw at you here. I'll go through some of them are quite long. I may not be able to get through all of them because we're at the halfway point already. Presumably, so the first question, do dentists who work on the NHS claim employer's allowance?
Yeah, I think, and I had this question, a similar question to this on something I was doing on Monday. I think there is a 50% rule with NHS employers. So it's how much time they're spending on the NHS. My understanding, and this is all relatively new news, is nothing is changing in terms of the criteria as to whether or not somebody is entitled to claim the employment allowance, other than the removal of the 100k rule that I talked about before. So everything we've done previously with a client as to whether or not they're eligible for the 5,000, we should continue doing that. And actually, so the NHS point, I've not seen anything to suggest it's changing. I've also not seen anything to suggest that single director companies without any employees will get it, and I don't think they will. And do remember, if we've got groups of companies or connected employers, there's usually a rule that says they have to pick one of them to claim it and the rest cannot.
That was a bigger answer than I expected.
Sorry,
I thought a yes or no.
I'm quite verbose.
You're fine. Yeah. So if we reduce a sole director salary to 5k per year, as they don't get employer's allowance, will they still get credit for national insurance for the state pension? Says Rian.
Okay. Another great question, and my understanding is no. So what we are seeing is the lower earnings limit increase slightly to £6,500 next year. Again, for those keen people watching the screen, I do have a slide that will show that. Here we go. No, not that one. I maybe haven't got a slide that will show that. So I'll just tell you, it's £6,500 next year. So I've seen nothing to suggest any rule change that a person needs to be earning more than that 6,500. It's something like 6,396 at the moment in order to start to have a qualifying year for state pension and other state benefit purposes. So we were going to touch a little bit on remuneration planning later, but now's probably as good a time as any to do it as we've started getting into that, if that's okay with you, Andy?
Yep, let's do that because we are running. We've got three more of your friends to meet.
I've got so many imaginary friends.
You've got so many.
It's
quite disturbing.
Yeah, I know. So So we've been talking about these changes since last Thursday when we did our 2020 Innovation webinar. And of course, a lot of accountants are straight out there. How can I help my clients do the best they can with this? And extraction planning for owner-managed businesses is absolutely up there. So I do have a bit more to come on, Andy, and even employer costs generally, but just on this employer's.
So the next slide is looking ahead.
Yeah. It can come on screen, or I can just talk around it, either or. So as we're seeing these sort of costs go up, we've looked at the graphs and said, when you look at a graph, it looks quite incremental, but I'm sure a number of business owners would appreciate some help in working out what it will mean for them for the year and years ahead. So helping clients plan and budget, that's going to be our 101. Now, in terms of the extraction planning point, this increased employment allowance may or may not make a difference. I often, in my own personal calculations for training purposes, assume that owner-managers are not going to get it for two reasons. One is they might be a single director company, and like I've said, if they've got no team members, they can't claim it. The other scenario is they have a team, and the team salaries themselves are using up the employer's allowance. So whether we pay that director or directors 5,000, 10,000, 20,000, 50,000, the employment allowance is often either not there or it's being allocated to other in the team anyway. Now, I do accept there are scenarios where the directors will be able to claim the employment allowance themselves, and that does change the direction for extraction planning. Now, to the point that just came in terms of optimum salaries, as always, every situation is different and we should verify this for a particular client. But from the calculations we've done so far, our pretty standard extraction planning of a salary of 12,570 plus divs to the top of the basic rate band or to the amount of cash need the client has, where we're able to do so sufficient distributable reserves and all of that good stuff, that pretty basic planning is still likely to work in 25, 26 and beyond. What we can see is that once an individual is earning an amount so their personal allowance is phased down or out, i.e. they've got total earnings of more than 100,000, then the optimum salary will drop. So the optimum salary is 12,570 where they've got a personal allowance. If their personal allowance is a lower amount, their optimum salary is a lower amount as well. Down to this £5,000 level where employer's NIC starts to apply. So if we just look at optimum tax from an extraction planning point of view, for an individual that is earning so much that they haven't got a personal allowance, 5,000 becomes the optimum salary. But Andy, to your person that asked that great question, 5,000 is not going to get that person a qualifying year for state benefits. So if those qualifying years matter to the individual, then we're going to up that optimum salary to that 6,500 level.
Yes, we have got a lot of questions about this, and I'm not sure we're going to be able to cover them all because are we still on Andy, or do we need to?
Shall we just finish?
Are we finished?
Off
There's a few more
on this. So I've mentioned salary, I've mentioned dividends, pension contributions. We'll come back to that in savers, but the upshot is they're still going to be a pretty great way of extracting funds. But it always depends on circumstances. And that's exactly why we're talking about personas. So we had a few other things on Andy.
I've got one question, which is quite an interesting one. I'd like to just... So Keeley says, you never used to have to register for a payroll scheme if there was employees with no other employment receiving less than £123 per week, or 6,396 per annum. Mm-hmm. Will scheme be needed for over 5k now?
I don't think it would be, because that...
I love it when she does that.
So it will be, because we're going to need to pay employers' NIC. So yes, I think you would have to. It isn't a question I've come across so far or thought about, but yeah, that limit.
Well done, Keeley.
Yeah, well done. Every time I'm lecturing at the moment, there's something new. I'm like, oh, that is a good point. So thank you. We're all working this out together. But yeah, I mean, if you're paying somebody over 5,000, there's now going to be an employer's NIC liability, and we're going to need a PAYE scheme to deal with that. So I can't see why not. So I would think so.
There we go.
There we are.
Right, let's move. Finish off the Andy, the business owner.
I had a third bit for employers before we talk about Andy more broadly. So we've talked about employers have got the employer's NIC hit. They've got the national minimum wage hit potentially. We also mustn't forget we've got the employment rights bill on the horizon as well. So more consultation coming on that in 2025, with implementation then expected in 2026 or later. And there is all sorts of new employee rights coming in. So again, great for the employees. But from an employer perspective, it's estimated that the employer community is going to need to spend £5 billion a year in implementing these new employment right requirements. And so it's just blow after blow for the likes of Andy. And yeah, he's going to have a tough few years.
Andy's all over the country are suffering.
Andy's are just
we're together.
They're not living their best life. And other message is going to carry on a little bit here with Andy. So that's the employment chunk. What we've also got is now changes upcoming, not immediate, to how much tax Andy's going to pay when he sells his business. We've also potentially got changes to how much tax Andy's going to pay if he's still a business owner. Well, Andy himself will be paying it, but in the event of Andy's demise and in passing his business on to his family members, we are seeing changes to inheritance tax as well. So now's probably a good time, if we're doing okay for time. I am mindful we can't do a full tax update today, but this is the big chunky area, to look at the capital gains and the inheritance tax changes that are new news from the budget last week.
Let's do it. Which slide do we need?
So I will go to our CGT slide first of all. Now this one does two things. So the first one is more of a to mention. It isn't specific to Andy and business owners. And the reason I've put pumpkins on the screen is that was my indication in our 2020 webinar that there's an effect as of Halloween. So we can see here we have got some changes to capital gains tax rates from 30th of October 2024. And that is for individuals disposing of assets that are not residential property and are not businesses qualifying for business asset disposal relief. That is on our top rows here, and we can see the rates have gone from 10% to 18% in the basic rate band and 20% to 24% when we are not a basic rate taxpayer. So those changes came in with immediate effect. If you are dealing with any clients that exchange contracts before 30th of October, technically, contract exchange date is our date of disposal, and that means they're going to be hoping to get the 10 and the 20% rates, the old rates. If the date of completion was after 30th of October, there are some specific rules in the draft legislation about whether the old rules or the new rates apply. So if we've got contract exchange pre-30th of October, complete after, do just have a look at the new rules, make sure we're applying the correct rates. And in some cases, we need to make special disclosure to HMRC as well. So just a heads up on that. The bit I really wanted to talk about today was the business asset disposal relief changes, because this is what's going to affect Andy. Interestingly, in the run-up to the budget, we were expecting quite significant changes to business asset disposal relief. Possibly a removal of it altogether. That didn't happen. Possibly a dropping in the lifetime allowance from 1 million. That didn't happen. What we have seen is that starting in April 2025, the rate of capital gains tax on these qualifying business asset disposals is going to start increasing. So the 10% remains in play for the entirety of the 24-25 tax year. For 25-26, it's going to increase to 14% if Andy is selling his business, either as a owner of a sole trade or shares in his qualifying company. And then from 26-27, that rate goes up to 18%. So we've got an almost doubling in the amount of capital gains tax being paid when a person disposes of their business.
Question here. So I think you may be coming on to this. I know you've got a good slide on this. What CGT rates would apply if the exchange of the contract was the 25th of October and completion on the 30th?
This is where we would, well, I've got a slide on the detail, but you might regret this. You've opened this door to it now.
It's kind of worms.
So here we go, everybody, and breathe. So the rates change for disposals on or after 30th of October 24. So if we've got an exchange before 30th of October, as per that question, technically the old 10% and 20% rates apply. Let me just be clear though on this question. This is only relevant if we've sold an asset that is not residential property, because there's been no change in rate for residential property disposals, and is not a qualifying business asset disposal relief disposal, because those rates haven't changed on 30th of October either. But if somebody sold a piece of art or a field, something like that, then yes, this applies. So where we have got exchange before 30th of October, completion on or after 30th of October, broadly what the revenue is saying is to retain those old lower rates, you have to be able to demonstrate that that disposal wasn't undertaken for the purposes of obtaining a tax advantage. Now, of course, a lot of people pushed for their disposals to go through before budget day because they were worried about what was going to happen on budget day. We haven't got any HMRC guidance as to how they would interpret this new legislation that's coming in. But I would think, just on a common sense point of view, if somebody was going to dispose of an asset anyway, and they've legitimately given up all rights to it, they've sold it to a third party, that isn't a contract that was entered into for the purposes of obtaining a tax advantage. There's also a point here in the legislation about if the two parties are connected, we need to be able to demonstrate that there was a commercial reason for that transfer. And again, it wasn't just being done to obtain a tax advantage. And interestingly, might just be me that finds this interesting, but if the disposal gain was more than 100,000, we have to disclose those reasons to HMRC upfront.
Okay. One question here: will there be any CGT impact for disposals related to excluded property trusts? Is this one of those ones where you look into the near distance?
I just need to think. Maybe we'll take that one offline. But I think, because I don't think that's going to fall into either of the camp of what's not changing. But let me take that one offline. That's okay.
That's
You're
fine.
picking out the really.
It's not me. It's not me.
There, aren't you? Yeah.
Okay. Are we ready to hit Alana? Are we going to meet Alana now?
I'm afraid no. There's more bad news.
Oh, there's
for
more.
Andy, yeah.
Oh, poor Andy.
Andy, we're just going to keep.
We're going to keep kicking Andy.
We're going to keep kicking Andy for a little bit longer, if we may. And we also said we'd talk about double cab pickups, didn't we, in this bit?
Oh, yes.
But before we talk about, as one of my colleagues called it last week, the double cab hiccup.
Oh, yeah. Who was that?
We love it. We've also, and this has been very widely reported in the press, I'm sure you're all aware, we've also got the inheritance tax changes. Now, the business asset disposal relief changes, remember, start to impact from April 25. What we are seeing on the inheritance tax side are proposed changes to come in from April 2026. So this isn't going to be in the next finance bill. However, we've got a Chancellor pretty committed to doing it, I would say. So at the moment, if Andy makes a lifetime transfer or on death leaves his business in his estate to his chosen beneficiaries, subject to qualifying criteria being met, that is going to get business property relief, which means 100% of the business value is exempt from inheritance tax. What the Chancellor is saying is that from 26, 27 and onwards, for both business property and agricultural property, and that's where there's a lot of talk about farmers at the moment, there will be a £1 million per person limit on how much 100% BPR and APR, business property relief and agricultural property relief can be claimed. So if we've got a business valued at 2 million, 1 million of that can go through at 100% inheritance tax relief. The other million is going to go through at 50% relief. And with an inheritance tax rate of 40% in most cases, that means an effective 20% rate of inheritance tax on that business. So that's just, that's going to affect Andy's estate planning and what he wants to do with his business in the future.
Well, let's assume Andy's not going to pass on just right now.
Yeah.
But he's got a vehicle.
Ah, is it?
Or has he?
Is it full of Labrador puppies?
It is, yes.
Yeah,
yes,
okay.
Like that one, like your one.
So the double cab pickup point, relevant for business owners and employers. See, this didn't make a headline, but I do know a number of your clients will be quite interested in this. So over the last few years, there's been a lot of talk about a tax case being, a tax dispute between HMRC and Coca-Cola. And it was all about what's a car, what's a van. And that case really brought home that for the preferential van treatment for both benefits in kind and capital allowances, it does need to be a vehicle predominantly designed for the carriage of goods. So if we've got space to carry passengers, that is going to start to be a problem. But what we've had is precedent giving special treatment for double cab pickups. And even though we'll have, by virtue of this double cab name, a row for the driver and passenger, a row behind them for more passengers, and then the open cab at the back. as long as that open cab at the back had was able to carry a payload of more than 1 tonne, we've been able to treat these vehicles as goods vehicles, or vans if you like, which means much lower benefits in kind if an employee is using them for private travel, and indeed much more grace as to what counts as private travel in the first place. And from a capital allowances point of view, we've been able to claim the 100% annual investment allowance and equivalent. Now, last year, under the Conservative Party, they announced, and you might remember hearing about this in the news at the time, I think it was July time last year, we're going to reclassify them as cars, we're going to update the guidance. And there was uproar from the business community, the farming community in particular, and they did a very embarrassing U-turn and put all of their guidance back to how it was before and said, whoa, okay, we won't change the rules. The Labour government are not feeling quite so sympathetic to the double cab pickup market, and the rules are going to change from broadly April 2025. Again, there's some good complex tax legislation about what and when for the point of cut-off, but broadly from 25-26 and onwards, a double cab pickup is likely to be classed as a car unless we can demonstrate it is predominantly designed for the carriage of goods. And with their standard build, that's pretty unlikely. So that means higher benefits in kind for people using them in an employment and lower capital allowances for the business themselves. Now, this will all be for vehicles acquired after the date of change. So for any vehicles already bought or in use, that's going to be okay. And indeed for those bought prior to April 25. So I'm sure there's going to be a lot of conversations going on about, are you looking to replace your double cab pickup over the next couple of years or buy any more vehicles into the business? If so, timing is going to be critical.
Okay, one quick question on that. We'll keep it quick. Does this apply to standard vans which have seats fitted but no windows in the back of the van?
So the double cab pickup change won't impact it, but the Coca-Cola case that we've been talking about for years would do. Sorry, Andy, just run me through that again. What have we got?
So we've got a standard van, seats
van.
Fitted, I presume in the back, other than seats in the front as well, but no windows in the back. It's a pretty miserable experience.
Yeah, no, the seats are going to be a problem. So I would suggest, what are the seats back there for? They're not for the carriage of goods. So unless a vehicle is predominantly designed and used for the carriage of goods, it's likely to fall on the car side of the line. Now, on the Coca-Cola case, that the vehicle that was discussed did have windows in the back and a row of seats in the back. So it's a bit different, but I think seats are probably more important than windows. If you've got the seats, it would suggest it's designed partially for the carriage of passengers, which is not wholly for the carriage of goods.
Fab. We do have lots of other questions. I'm not going to go into those because we've
more
got
imaginary friends.
Yeah, let's meet.
We'll
is Alana coming now? Is popping
Alana's
in?
Here.
Hey,
Alana's
Alana.
Here. Alana, but we've talked about Alana or the equivalent of Alana previously. So changes coming afoot, but this isn't necessarily new news. So we did think we might see worse news for landlords, it's fair to say, but the rates of income tax and corporation tax on rental profits remain unchanged. As we've already talked about, for individuals selling residential property, no change in the capital gains tax rates. Of course, what's potentially on the horizon for Alana is if her rental property is a furnished holiday let, we are ripping those tax advantages away from the 25-26 tax year. And I think we talked about that last time I was in the tax.
We did, absolutely.
Yeah, so we can look back at the previous webinar podcast for more information.
It's on the podcast channel.
Yeah, but if you have got, going back to Dean's point earlier about client communication, really important, if you've not already done so, to identify your clients that do hold furnished holiday lets and work with them in the run-up to April 2025. So that might be forecasting how their tax will look different in the future. There could also be some really proactive advice around timing of expenditure. I wrote a blog a couple of months ago about converting a loft, and whether we do that before or after April 2025 can make a real difference. So yeah, keep our eyes out for the likes of Alana. Remember, I mentioned earlier, stamp duty land tax rates are changing. If she's looking to buy any more properties, furnished holiday lets or otherwise, just going to jump into the SDLT section of the slide pack. if I can find it quickly. Just a flag, we have a hanging pumpkin here, which means there was an immediate change. So that is for those buying additional property. They already own a residential property. Whether they live in it or rent it out doesn't matter. They already own one. They're buying their second or onwards. There already has been a surcharge of plus 3% to the SDLT rates. With immediate effect from budget day, that is now plus 5%. So Alana needs to watch out for that. Who's next?
Okay, I think we're going to hit Tracy. Yeah, Tracy.
Tracy.
What does Tracy do?
Tracy is just sitting on her assets and enjoying the natural wealth that comes from it.
She's a saver.
Tracy is a saver. And we thought savers might take more of a hit. Now, we have talked about capital gains tax already, but what is likely to be quite a relief, I would think, for Tracy, is that the regime around individual savings accounts, ISAs, hasn't changed. So an individual can still put £20,000 a year, up to £20,000 a year, into an individual savings account, cash or stocks and shares, and that savings pot is any returns generated are exempt from tax. From a pensions point of view, we were expecting pensions to be hit quite hard in the budget, and in the main, there is one point we need to come to, but in the main, not. So an individual making pension contributions is still going to get tax relief at their marginal rates of tax. From an employer's perspective, if they make employee pension contributions, that is not triggering employer's NIC. So the position for savers is actually pretty static. We do have the uplift in capital gains tax, the increase from 10 and 20% to 18 and 24% that we've already talked about. But Tracy's probably in the main thinking, phew, I would think. The one thing on pensions that we've got here at the bottom is not happening until April 2027. And my goodness, we've got a long way to go between now and April 2027. Who knows what's going to happen in politics between then and now. But the current plan is that undrawn pension funds and some other aspects currently outside of inheritance tax estate may well be brought into it or are likely to be brought into inheritance tax estates from April 2027.
Well, I think you've touched on a point there that at least we know that, you know, tax may go up and down, but global politics remains completely steady, and there's
everything is fine.
Turmoil
fine.
there
Fine.
to worry about.
Fine. On the 6th of November 2024, everything is fine.
Absolutely fine. Question here, re-IHT. Are the changes on potentially... Hang on, I'll put my teeth in. Are the changes on potentially exempt transfers failing if someone dies within the 7 years they have failed taking effect from the budget date or 5th of April 26? I'm not sure I'm reading that correctly.
I think I have followed. I know to a non-tax person, you think you've just read something out in French.
Yeah, basically.
Yeah. It was somebody wanted to see this picture, if we could pop the slide on the screen, of a pet. Because
that's what they wanted, yeah.
This is what it's all about. So I knew what we're talking about when we brought up potentially exempt transfers, if we want to see a kitten under a blanket. So there was speculation that the inheritance tax rules would change in regard to the 7-year pet rule. Andy would probably have to read the question to me again, which we probably won't do now. But let me just say that the 7-year pet rule hasn't changed. So if an individual makes a lifetime transfer, let's say of business property, in their lifetime, and then they live 7 years after that transfer, and then there's a later death, that because we've got that 7-year window still in play, that didn't change in the budget, those 7-year plus gifts are not going to come into the estate for inheritance tax purposes.
Fabulous. Excellent. Okay, so we've got quick time to meet our foreign
Let's talk
friend.
about Ed.
He's not foreign, but he's returned.
Yes, well, Ed's internationally mobile.
Hello, Ed.
We'll be really, really quick on Ed, because again, this isn't really new news, it's tweaked news. We knew there was going to be a plan to remove the remittance basis of taxation from April 2025, and indeed the remittance basis of taxation will be removed from April 2025. So for income tax and capital gains tax, we're moving to a new 4-year foreign income and gain regime, which means let's assume Ed's never settled in the UK previously. He's born overseas, lived overseas. He comes to the UK in 25-26 and settles here. For his first 4 tax years of residency, based on the statutory residence test, he will be exempt from UK income tax and gains on his income earned outside of the UK and his gains he disposes on assets that are based outside of the UK. But in year 5 and onwards, we're not going to be that generous anymore. Ed's worldwide income and gains will be assessed in the UK. And a bit of a similar change for Ed from inheritance tax point of view. If he stays here for 10 years, so we've got 10 years plus of the last 20 years being established in the UK, we're going to go after his worldwide assets for UK inheritance tax purposes. Whereas at the moment, we only go after the assets located in the UK.
Okay.
In most cases.
Right. Okay, so big changes for the non-doms.
So again, that's
the
another,
doms.
going back to your point, Dean, about personalised communication. We've talked about identifying the business owners. We've talked about identifying the savers. We've talked now about the individuals that currently benefit from the non-domiciled regime. They're going to need some careful advice over the coming weeks and months.
Okay, so quick question popped in. I know we've got a few kind of random bits to cover. Have the rules on inherited pension income, where the donor died before the age of 75, changed? Currently income tax free. Inherited pension income.
Yeah, so that one is more complicated, but I think it would. So if at the moment it escapes the estate, the point is going forward it's coming into the estate for inheritance tax. So I think, yes, that would change.
So that will be part of it. Okay, fabulous. Okay, so I've got a whole bunch of questions to go
Let's
out here.
do it, yeah.
Dean, was there anything that jumped out at you? Do you want to pick on? Because we can cover double cabs. We can cover. I'm going to go for that one.
Go for it.
I think if a client has claimed capital allowance on a double cab pickup as a van,
Yep.
e.g. 100% of business use van,
Yep.
and annual investment allowance already claimed,
Yep.
is there any impact?
No, that will be fine. So we're not going to have to do deemed disposals or anything like that. It just means that when they come to dispose of it in future and buy a new one, when they next buy one, assuming it's, like I say, there's blurry cut-off rules around the April point, but assuming it's in the new regime, when they buy a new one, they're probably not going to get the annual investment allowance because it's going to be treated as a car. So instead, it's going to be going into one of the pools, depending on the emission level, and we're getting writing down allowances at 18 or 6% per annum.
Fabulous. Okay, and we'll have one more question. Again, around the cars, is VAT still claimable on double cab pickups once the new rules come in?
Oh, you've asked me a VAT question. I'm pretty sure, 95% sure that I have seen from my VAT colleague that the VAT rules don't change on double cab pickups.
Okay.
So I have a little bit of uncertainty on that, but no, I think the VAT rules remain the same.
Fabulous. Okay, and I'm going to leave you because we've come to the end we've had our hour.
Mm-hmm.
I'm going to ask one question because I thought this was great fun, and I'm going to ask.
We haven't talked about tax advisors.
We haven't done tax advisors.
Yeah, I'll pop the slide on while you're asking the question.
Yes. So, do you want to, if you just go through what's being required of people?
Yeah. So I was telling Andy before we got started today about. So we've talked about the impact on individuals, but there is also a little bit of impact on agents. For most of us in this session today, probably not a direct impact, but this is continuing the consultation we've had over the last couple of years about should tax advice be defined and should there be regulation over delivery of tax advice services in the same way. None of us here, to the best of my knowledge, could call ourselves a solicitor, but any of us here, including Andy, could call himself an accountant or indeed a tax advisor with your potentially exempt transfers.
I sometimes do.
I know. But to be fair to Andy, none of us know what a chief operation.
I don't
anyway,
know.
Yeah, we don't.
Chief medical officer.
A chief medical officer does either. Is it a regulated activity? And there's been a lot of talk around this because the revenue worry about tax gap through poor advice being given. So we saw a consultation earlier this year about the revenues preference that everybody giving tax advice would need to be a member of a professional body. We hadn't seen the Labour move on this yet. So interesting to see that Labour are moving on with this discussion, but we're not going too fast. So this we've got on the slide is step 1. And what they're doing as step 1 is saying that from April 2026, everyone acting as a tax practitioner will need to register with HMRC. So that means we won't have individuals, or shouldn't have individuals out there acting on behalf of others, but doing it via them. So they're not, the advisor isn't personally registered with HMRC. So agent registration is already in play for a lot of professional firms, but making sure everybody acting as a tax advisor is registered from 26, but with that bigger discussion still taking place. And what we were talking about was the optimism, wasn't it, of how much tax revenue?
Yeah, this is quite staggering. So I'm going to put this out for an informal poll.
Yeah.
If you put your answer in the chat, just for fun, but I want to see the first person to get the answer of how much has the Treasury forecast to generate each year from the mandation of registration for tax practitioners by the end of Parliament, so in 5 years' time. What do you think their annual income, or are they predicting their annual income will be?
Do you think they'll get through
By regulating in
by
that way.
making everybody register?
So
How much
answers in the
extra
chat.
tax will
Oh,
be
we've
paid
got
as a
some
result
very,
of
so we've got some very,
Billions, I know.
we've got 4 billion, I think, came in. So far, I think Lisa's come closest, 15 pence. I think it may be a tad more than that. I mean,
think
it's
there's a lot of correct answers for the actual amount
Yeah,
of
the-
additional
Yeah.
tax
It's reality versus these
Collected,
budgetary forecasts, isn't it?
But yeah, so no
Yeah.
one's got the actual answer. I think Lisa has come sorry, it was 30 billion. Lisa thought it was. It's 40 million quid.
£40 million a year they think they're going to get by 28-29 through everybody acting as a tax agent being registered with HMRC. I mean, we try not to get political, don't we? But it just raises some questions, I think, over the forecast.
That's something else, isn't it? Anyway,
Yeah.
okay. So thank you all very, very much for coming. Thank you very much for joining, and particularly Sharon. I know you've come in fresh from your conference. We were at the conference too, and it was, I'm top of my team, had a wonderful time. I've always had a wonderful time at the 2020 conference. If you want to find out more about 2020 and the work that they do, please go to 2020innovation.com. Where you can find out all about what they've been up to. If you want to look into, we were talking earlier about how you communicate the budget information to your clients. We have a nice bit of software called Communication Center, which allows you to send out communications and schedule those communications to your clients. In the meantime, we will have one more session this year. We're going to have a power hour, and that will be in December, probably the 17th, and we will have our Christmas power hour. We have a Christmas quiz. The power hour, for those who don't attend, you should come along. We look into how you can use TaxCalc more effectively. All those tricks and tools that you have already got within your TaxCalc, we will show you how to use them. We have a great time too, and we may even dress up. After that, we will be back in the new year. We leave January alone, but we will be back on the 19th of February, where we will be joined by Craig Ogilvie from HMRC, who's going to tell us about this MTD, which they've been talking about it very low key for a while. But Craig Ogilvie is the head of transformation over at HMRC, and he's going to be talking through where they're at, what their plans are, how you can get involved should you want to. So that is going to be a really important one. Please do come along to that one. But in the meantime, thank you very, very much for coming. Thank you once again, Sharon. Thank you, Dean. Apologies for any issues around the sound, but we will be back on the, I think probably the 17th of December. Take care.
You have been listening to the TaxCalc podcast of the TaxCalc webinar Autumn Budget 2024 Expert Analysis with Sharon Cooke. It was presented by Andy North, Dean Shepherd and special guest Sharon Cooke. The original webinar was broadcast on the 6th of November 2024 and can be viewed at www.taxcalc.com/events. Please be aware that deadlines, rates and other technical details referenced may have changed since this date.